Brent just fell below $89. WTI dropped toward $82.77, while the Strait of Hormuz standoff keeps threatening supply. Prices are falling even though supply risk is rising. That contradiction is exactly why petrocurrencies are getting whipsawed right now. By the end of this, you'll know the one currency most exposed to this shift and the actionable way traders are framing it. OPEC just slashed its 2026 demand growth forecast to 580,000 barrels a day, down from 780,000 in July. The IEA went further, projecting a contraction of 1.6 million barrels a day this year, a 510,000 barrel downgrade. A surprise 17.4 million barrel build in US crude inventories added fuel to the bearish demand story. So who actually gets hit? Lower long-term oil demand hits currencies tied directly to crude export revenue. The Canadian dollar is the most exposed G10 currency here. USD CAD tends to rise as Brent and WTI soften. Norway's krone faces the same pressure against the euro and dollar, tied to its oil-funded sovereign wealth flows. The ruble sits in a messier spot. Exports already at their lowest since May, refineries hit by drone strikes, but capital controls make ruble price action a less reliable read on pure oil demand signals than CAD or NOK. Here's the mechanism. Currencies price terms of trade expectations, not just spot oil prices. Norway's central bank ties krone buying flows to oil revenue through its pension fund. Weaker demand means weaker structural NOK support. Canada's link is even more direct. Energy exports are a big share of GDP, softening Bank of Canada rate hike bets. Stick around. The actual currency to watch is still coming. Not everyone loses here. The yen, rupee, and lira all benefit from cheaper energy import bills. But the caveat is huge. This demand destruction is being driven by high prices tied to Hormuz risk, not falling consumption. If US-Iran talks ease tensions, prices could spike back fast, reversing this CAD and NOK weakness overnight. The one currency most exposed here is the Canadian dollar. USD CAD carries the cleanest, most direct link to this demand story. Traders are watching USD CAD longs on dips alongside NOK shorts versus CHF or JPY as the demand downgrade trade, the real risk. Position sizing matters because oil FX correlations can break down sharply the moment Hormuz headlines shift. Read the full analysis on edge-forex.com. Link is in the description.